Hi, good morning. I'm Susie Stewartson with the Summit team at UFirst Realty. Today we're going to be talking about financing a home purchase, and with me today is my very good friend DJ Robbins, who has been in the business for 30 years plus, and he is an expert on all loan products. Thanks for coming in, DJ. Thank you.
Thanks, Susie, for having me. I've known the Summit team for an extremely long time.
Yep.
We've done quite a few deals together, helped quite a few families out, a lot of families that were turned down by other lenders, and we have been able to figure it out and get them into the home.
Yeah, you're an expert at that.
Thank you.
Definitely.
So thanks for having me.
Of course. Absolutely. So I have a lot of viewers that really are confused when it comes to the different types of loans that are available and what they have to do to qualify for those loans. So I was wondering if you could touch base on, normally we work with conventional products, FHA, VA, on occasion USDA, and then there's a few other ones, but I thought those would be the main ones we talk about. Okay, so go ahead.
Yeah, let's start off with conventional.
Okay, great.
You know, a big misnomer that a lot of our viewers have is you have to have 20% down in order to qualify for a conventional loan, and that can be further from the truth. Conventional requires a minimum 620 credit score.
Okay.
You can go as low as 3% down, depending on desktop approval. Their income limits, the median income limits per county, but there are those types of programs out there that can go as low as 3% down.
And that's what a lot of my people think of as a first-time homebuyer program. Is that correct?
Correct. And it can be a second-time homebuyer. It's really.
Is there a rule about that?
No, no rules.
No rules. So they could apply and they could still do the 3% down.
Absolutely.
Okay.
Absolutely.
Okay, great.
So you have 3% down, then 5% down.
Yeah.
10% down, 15% down, and then 20% down with no MI.
Okay.
It's always best to either put 3% down or 5. You don't want to put 4% down because you have the MI rate of a 3% down type of payment.
Okay.
So
can you explain what private mortgage insurance is to our listeners? Because I think there's some confusion there too.
Absolutely. It protects the lender.
Yeah.
So if the borrower defaults, it protects the lender in regards to the deficiency balance.
And normally they have to pay a bit up front as well as a monthly fee, correct?
You can buy it out.
Okay.
So on conventional loans, you can buy out the MI. Okay. So when you buy that out, it's a higher interest rate versus having the monthly MI. So MI goes away after you attain 20% equity in the house.
Right.
Is that year 1, year 10?
Whatever. It depends on the market.
Depends on the market.
Sure.
That's exactly correct. So, you know, and what I always tell my borrowers is that how long are you going to be in the home? Is it better to pay a higher interest rate because you're going to be in the home on a shorter amount of time?
Yeah.
Or are you going to be in the home a longer period where you have a lower interest rate and the MI eventually, hopefully, goes away once you attain that 20% equity?
I see. So, and I have a lot of folks that get an FHA loan. So what are the differences between conventional and FHA?
Absolutely, absolutely. So FHA is more forgiving on credit scores.
Okay, so meaning what? You said 620 on the previous one.
Yeah, exactly. So FHA, you can go down to as low as a 580 credit score.
Okay.
I do have lenders that go as low as 500 on FHA.
Okay.
In order to go below a 580 credit score, you'll need 10% down and no derogatory credit within the last 12 months.
Okay. So, but normally I don't see that. Typically people are still having to do, 600, 620 FICO score, correct? And they can't have any collections, things like that.
On a 580, basically you can have collections.
You can?
Yeah, absolutely. And the beauty about FHA is you can do a manual underwrite if you have the correct debt ratio. So an underwriter can actually manually underwrite an approval if it doesn't get approved through desktop underwriting.
I see.
So a little bit more latitude. So FHA, you have the upfront mortgage insurance premium, which is 1.75%. And it don't matter if you have a 500 credit score or an 800 credit score.
They're still going to charge
They still charge that.
And don't they keep requiring that payment up to 13 years, was it?
That's a one-time.
That's a
the
one-time.
upfront mortgage insurance
Oh, I
premium
see. Okay.
is upfront one time.
Gotcha.
And that's 1.75% of the base loan amount.
Awesome.
I think what you're mentioning is mortgage insurance.
Right.
So with mortgage insurance with FHA, down payment of 3.5%, you're going to have a 0.85% factor for the mortgage insurance.
Okay.
And if you put 5% down, it's going to be a 0.8 factor on the mortgage insurance.
So slightly less.
Exactly.
I see.
So,
Okay.
and again, it doesn't matter if it's a 500 credit, if a borrower has a 500 credit score or an 800 credit score.
Okay.
Everybody pays the same thing
Okay.
on mortgage,
That makes
on
sense.
the mortgage insurance. So, whereas conventional, it's very credit score oriented.
Right.
The higher the credit score, the lower the MI.
Right.
The higher the credit score, the better the interest rate.
Yeah.
So it all is kind of perspective when we, look at our clients. We give them options. Is conventional the best way to go, or is FHA a better route to go?
Gotcha.
So,
Well, and then in Colorado, we have what we call CHAFA, which is a down payment assistance program, and I have a lot of clients that use that. So CHAFA, my understanding is that CHAFA actually pays that down payment for a borrower, and it can be either a conventional or an FHA product, correct?
Correct.
Okay.
Correct.
So they usually have to come in with what, $2,000 roughly?
It depends if the seller pays the closing costs.
Yeah.
So
Okay.
basically, conventional with CHAFA has their income limits, whereas FHA has really no income limits with
Okay.
CHAFA.
Yeah.
So I do a lot of FHA, CHAFA types of deals
I
where,
see.
and they have two different second mortgages is really what they are.
Okay.
They have the grant program,
Yeah.
and then they have the basically a 0% program. The 0% program, zero interest, zero payment, they give you 4%
Okay.
up front, or when you go to close on the deal.
I see.
So part of that is 3.5 for your down payment. The other 0.5% can be used
For
for
closing costs
closing
or-
costs.
I see.
Exactly. The beauty about CHAFA is you can get into a home as low as $1,000 down.
Yeah.
Now, in order to do that, the seller would be paying the closing costs in order to make that happen.
Right. And in today's market, we're getting that.
Absolutely.
We're also getting buy downs from the sellers just because the prices have stabilized and they're a little more, what's the word?
Forgiving.
Forgiving. Yeah, that's a good word. Okay, that sounds great. Then we have VA, which is just for veterans.
Correct.
And is there any difference between VA requirements versus FHA or conventional?
Really, VA is a great loan. It helps our veterans.
Yeah.
Again, they kind of follow along the same guidelines as FHA in regards to credit scores.
Okay.
Again, I can go as low as a 500 credit score
Okay.
for VA.
All right.
The beauty about VA is it's 100% financing.
Yeah.
And literally, we get clients into homes at 0% down.
Right.
There's no mortgage insurance.
Right.
They pay.
So that's a huge thing.
Absolutely,
Yeah.
absolutely. They pay a VA funding fee,
Right.
and but very, very good loan. So,
Yeah, okay. And then I've got a few others just to touch on them. Jumbo loans are typically an 80-20 loan or 90-10?
There's lenders out there now that basically 89.99%.
Okay.
But you have the mortgage insurance.
Correct.
So what we do is I call it a jumbo buster, for example.
Okay.
So you would do an 80% first mortgage
Right.
as a conventional loan,
Yep.
and then a 10% second mortgage.
And they still have to come in with 10%.
And they
then.
come in with a 10% down.
I see.
Exactly,
Okay.
exactly.
And then land loans and construction loans, I kind of lump them together. What I have found is that they typically require at least 20% down. Is that correct?
Typically, yes,
Yeah.
that is correct.
So they're a little more complicated.
Yeah, a lot of folks though, they may have a piece of ground they bought a few years ago.
Yeah.
And they're just holding on to it.
Sure.
And now it's time to build on it.
Yeah.
So that land can be used as part of the down payment
Oh,
for
I
the
see.
construction loan.
Oh, I didn't know that.
Yeah,
Okay.
exactly. So
Okay.
the construction loan is a little bit more detailed. You need contractor bids,
Sure.
and the homeowner can't do any of the construction.
Right.
Don't matter if they're a
That's
GC
good.
or not.
That's really good to know because I think a lot of people have a idea that they want to build, and it's a lot more complicated than you would think,
Yeah.
Especially on the lending side.
Exactly.
And then just briefly, I get a lot of folks that are looking for a lot of space. They have kids or whatever, and they just can't qualify for a house, but they consider a mobile home and a mobile home park.
Mm-hmm.
And I let them know that in general, those loans are very high interest rate. They're considered like a car loan. Could you just touch base on that?
Yeah, typically, with mobile homes in a park, it really depends on the year of the mobile home.
Yeah.
In regards to the terms of the refinance.
Yeah.
So a newer mobile home is probably going to have a 20-year repay.
Okay.
As the older they get, I've heard as low as 7 years.
Oh, wow.
So
I
that
didn't know
can
that.
really bump
Yeah.
up that payment. Then the
Sure.
other thing is you have lot rent.
Right, and
that-
that's $700 or $800 a month minimum.
Exactly,
typically.
exactly. And
So-
a mobile home is typically a depreciating asset.
Correct.
Like a vehicle.
Right.
Because it's a title.
Yeah. Right.
And it's not.
It's not
real
really
property.
even considered real estate, right?
Exactly, it's not
So
real
it's just to clarify, it's you're probably not saving any money on your payment if you do something like that.
Correct. But the other thing is, a home is an investment.
Sure.
A mobile home, are you gonna make money?
Right.
And our last period that we've gone through,
Yeah.
you did make money on a mobile home.
Right.
But as things get tighter with interest rates,
Right.
mobile homes are typically
The first to go down.
Exactly.
Yeah, sure.
Exactly.
Okay. Let's see. We talked about that. Can you talk about the difference between pre-approval and pre-qualification? I think people are a little confused about that.
Sure. A pre-qualification, it's been years since that even has been brought up to me. But
Right.
typically we're having a conversation.
Sure.
I make this amount of money.
Yeah.
And this is my credit score.
Okay.
And can you? Yeah, that sounds great. You're pre-qual.
Yeah,
Okay.
okay.
Whereas a
Right.
pre-approval,
Yeah.
we're getting income.
Okay.
We're going through the process. We
So
pulled
you
credit.
actually get the documentation from
Exactly.
them to verify
Yeah.
that everything is
Exactly,
good.
exactly. So we pulled credit.
Yeah.
And you're pre-approved.
Okay.
We ran it through the desktop underwriting.
Okay.
If there's ever situations where there's borrowers that, you're right on that fence.
Yeah.
And with the income or credit or
something.
anything like that, we have what we call a to be determined pre-approval.
Okay.
So that means I send that into my underwriter, who gets back to me within 12 business hours.
Oh, I see.
Of being
Whether it's
qualified.
good or not, yeah.
Exactly. So when we put that, Golden Lenders puts that pre-approval letter together for
Yeah.
you, we're 99.9% sure
It's gonna
going to
close.
Exactly.
Okay.
So it's just not a piece of paper.
Yeah.
It's golden.
Yeah. Okay. Good to know. And then some of our folks have asked about student loans and how they can affect borrowing.
Sure.
I assume there's a couple of rules I know, but I maybe you could clarify.
Yeah,
that.
absolutely. So a lot of student loans obviously are not showing payments on our
Okay,
credit
because
reports.
they're in deferment.
Exactly.
Okay.
Exactly. So there's a couple different ways that we can do it. They can call their student loan provider, servicer,
Okay.
And get an estimated payment.
Okay.
And
And then you figure that into the debt to income?
exactly.
Okay, I see.
Or there's another way where it's just much more simple, and that is Fannie Mae. If the balance is $10,000, for example, you take 1% of that, and
Yeah.
that's the payment that we'd use. So
Oh, I
$100.
see.
Whereas Freddie Mac
Yeah.
and FHA,
Yeah.
they take 0.5%. So
Okay.
if we're teetering on those debt ratios on a conventional loan, do we
You
go
might
Fannie Mae or
flip
Freddie
it
Mac?
over to
Freddie
FHA,
Mac.
okay.
Yeah, or whichever route. So,
Whichever route.
Yeah.
Okay,
So-
and you might want to touch base. A lot of people have heard those terms. They don't know what that is. So what are those two institutions?
So Fannie Mae is basically, they're both conventional. Freddie Mac they're a little bit more forgiving in my opinion, in regards to. Like,
But they're a
student
government
loans.
entity,
Basically.
basically.
Yeah.
And my understanding is they buy the loan after we've closed on it. It's like a secondary market. Yeah.
They securitize.
They secure it. Okay.
Yep.
Okay, good. Let's see. I've got a couple of other ones. Obviously, mortgage rates are a little bit unstable right now. And if you could touch base on what you know, obviously a rising interest rate, I mean, I think everybody understands the payment goes up.
Correct.
But what do you expect to see in the next 12 months for the rates, the way they're going, where they're at now, that
Sure.
sort of thing, and what kind of strategies people can use?
Yeah, that's a great question. I mean, the rates a month ago were basically probably a half point to 3/4 of a point lower than
Right.
what they are today.
Correct. Yeah.
So it's really, you know, depends on inflation and, you know, different things in the market. The mortgage-backed securities right now are just, you know, are not being purchased. They're
Yeah.
at Wall Street and, you know,
Okay.
the different entities buying them.
Okay.
So what we do, there's a program out there right now. It's called a 2-1 buy down.
Okay.
And it's a great product. You know, I read something in Fannie Mae had put out, I think it was in August of 22, that they expect in 2023 average rates to be 4.5%.
Oh, wow.
But this 2-1 buy down is great. And basically the way it works is the buyer's agent requests seller concessions
Okay.
to buy down the interest rate for the buyer.
Gotcha.
So what happens is, let's say the rate, making a number up here, say it's 6.5 right now.
Yeah.
So on a 2-1 buy down, the first year, it's a fixed rate, is at 4.5%.
Oh, wow. Okay.
So let's say to do that, it costs $10,000.
Right.
Okay. So what happens is that the buyer's agent requests $10,000 on the contract
For the
as a seller concession.
Correct.
Okay. So buys it down to that 4.5 the first year.
Okay.
The second year is 5.5, and then it settles on the third year at 6.5.
Oh, I see. But if it goes down, they could refinance.
Absolutely. And
I
the
see.
other cool thing about this product is
Yeah.
that $10,000
Yeah.
sits in a buy down account, kind of like an escrow account.
Yeah.
But it sits with the lender.
Oh, wow.
And what happens is they take money out of that as the payment is being made.
Yeah.
They take it out of this account and combine it to buy that. So
I had
it's
no
a
idea.
$600
Yeah.
difference in payment.
Yeah.
They're taking $600 per month out
Yeah.
of that $10,000.
Oh, that makes total sense. Okay.
Which, you know, it's a great product.
Yeah.
Now, if there's, say the rates, they decide to refinance in 2023,
Yeah.
2024, whatever the case may be.
Yeah.
There's money left over in that account. When they go
Oh.
to pay that loan off, that goes toward their principal balance,
Oh, that's awesome.
which
okay.
is really big.
That's great.
So.
Yeah, okay, that's great to know. And I thought we'd touch base a little bit on adjustable rate mortgages. I think most people kind of know what they are, but good idea, bad? I mean, it sounds like that's what we were just talking about.
Well, I mean, you can do the buy downs on an
Yeah.
adjustable rate mortgage.
Sure.
My opinion is fixed rate's always the best rate to go.
I would agree. Yeah.
Just
I think
based
it's
on,
safer.
Yeah, exactly. And it's essentially the same interest rate.
Right.
So the buy down is the big thing right now.
Okay.
A lot of folks, a lot of buyers, in my opinion, are more worried about interest rates
Right,
than they are what the house values are.
right.
The great thing, like in this market, it's such a buyer's market.
Right.
You know, you can get seller concessions, you can get a reduction in the price.
Sure.
And kind of.
Yeah, and if it stays like that, what's great is that, you know, if the prices keep coming down, people can get a great price, they lock it in basically, and then when the rates go down, they can refi, and then they've got the best of both worlds.
Absolutely,
So,
absolutely.
because once the rates go down again, my opinion is that the prices of these homes are going to go right back up
Absolutely,
again.
I agree with you,
Yeah.
100%. I agree with you.
So,
We have such a, I mean, we have a shortage of inventory. At the end of
Sure.
the day, that's what it all boils down to.
Yeah.
In my opinion, this is nothing like it was in 8, 9, 10, 11.
Sure.
The housing market is what caused the crash.
yes,
The housing what we're in right now, it's not the
it's
housing.
very stable.
Yeah, it's the economy
Yeah,
that's
that's
causing
right.
this.
That's right. And there's a lot of folks out there that are just kind of, you know, sitting there with a lot of assets,
Yeah.
and I still think it's a much healthier economy even than it was back in 2008.
Absolutely.
Yeah.
There's no doubt about it.
Yeah.
No doubt about it.
Okay. Okay, so one thing that's a little off the subject, but I know you're an expert on it,
Right.
is flood insurance.
Sure.
So when we go to buy a home, there is a process where they check to see if the home sits in a floodplain. And if it does, then you have to pay a certain amount of money extra on top of the mortgage. But DJ has dealt with this a lot, and I thought if he could comment, that
Sure.
would be great.
Absolutely, absolutely.
Okay.
So a lot of banks, lenders, if any part of the parcel of the home is in a flood zone, it's an automatic that you have to give flood coverage.
Right.
Couldn't be any further from the truth.
Yeah.
Basically, if any part of the home is in a flood zone that shows up on the map,
Right.
then you need flood coverage. But there's ways around that.
Right.
You can, build it up.
Right.
Or whatever part is in the flood zone, is there, a way to make that higher than what the flood map
Well, and my
requires.
understanding is most of these homes need what they call an elevation certificate, which you would
Exactly.
get from a surveyor. But if the home itself does not touch the floodplain, then technically it's not in a flood
Absolutely.
zone.
Exactly.
But if it does, and the lowest level of that home, including the basement, is higher than that floodplain level, then I think that it's exempt as well, or it's very reduced.
Right, right.
But outbuildings and things like that are probably not the same thing. But there's
That's
a lot of confusion about it. And I think if you guys ever have any questions about it, call me, call DJ. We can walk you through it.
Absolutely.
So,
Thank you for having me.
yeah, of course. Thank
It's
you.
always-
This has been very interesting.
Absolutely.
Very helpful.
Absolutely.
Okay. Thank you.
Thank you.